All right, everybody. Rick here for another Facebook Live. I got fooled by there for a second. And today we have the lovely Leistra Henson from Prosperity Mortgage. All right. Well, Leistra, okay, I know who you are. Paul knows who you are. But tell everybody who you are, how long you've been doing this, a little about yourself, please.
Oh my goodness. So good morning, everyone. My name's Leistra Henson, and I am coming to you from Las Vegas. A little bit about myself, originally from Phoenix, Arizona. Relocated to Las Vegas over 20 years ago by way of a different job that I had after graduating from college, right? But I ended up staying out here and getting into lending, subprime lending in 2001, and worked for another company, another financial company for a few years, managed a lending branch for a few years, opened a real estate development branch on the lending side, and then decided that I wanted to go ahead and pick up my real estate license for flexibility. Everyone says that, right? Flexibility. But anyway, so was licensed for about 10 years and decided to go ahead and step back into lending. And so collectively, and so I've worked for some large banks and things like that. The opportunity was presented to me to join Prosperity as a mortgage consultant. Prosperity, since we are part of the Berkshire network, I was very excited about the opportunity. Who's not excited about a name, Prosperity Mortgage, right?
Right.
Mortgage.
You gotta
So
prosper.
exactly, prosper local. That's what we are striving to do. But anyway, so I accepted the challenge last year. And so I've been focusing on lending for about a year with Prosperity. Here's what I tell people. Here's a funny story. And I hope that this is consistent. If you find some inconsistencies, just let me know. But on all of my profiles online, right? Because people will let you know. Anyway, on my profiles online, it shows that my experience is 18 years, right?
Right.
In lending and real estate, in management and sales leadership, whatever, blah, 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 blah. It's probably been lending in real estate, more than 18 years, but I don't really go back. I just hang it there. So it doesn't really matter because in today's world, there's so many changes in lending. I don't know that anyone can ever, I don't want to say feel comfortable, but you'll never know everything in one given day. There's always different nuances. So anyway, I'm glad to be here representing Prosperity. I honestly, it's a ride that I'm grateful for. And that's me, Leistra Henson.
Yeah, and you primarily work in Las Vegas, out of the Southwest office, correct?
The Southwest and the Sahara.
And Sahara, right?
Yes, I support both. But you know what? There's 5, soon to be 6 of us, and we really are here to support the entire Las Vegas team. All of us.
Yes, I did see you at Sahara one day, right when I was there. That's right. Yes.
Yeah.
2 great offices, great locations, and and we're obviously excited to have you here too, Leistra. You bring great experience, great attitude. You help people. It's incredibly good, and you're just fun to work with too. Now that we're both companies are part of Berkshire Hathaway, or as I call it, the Uncle Warren companies.
Uncle Warren, Home Services of America. You got it. Yes, exactly.
Uncle Warren is the real deal.
He's the real deal. Right.
All right. So give us a little update about, so yesterday we had this, what are these people called? What are they? Oh yeah, they call them the Feds, right?
Yeah.
They came out dancing and introduced for the first time in the history of mankind, or at least our country, a 0.75 increase, the third one this year. So that's got to it's got to be affecting the lending business a little bit, right?
It is big time. Yeah, it is. And so, so Feds, so they raise current prime. There's different there's different measuring tools, if you will. Typically, when rates are raised, we usually will see the mortgage bond, rates go the opposite direction.
Right,
I'm
right.
checking to see as of this morning, we are back up. We're anticipating, so it's just going to be a rockery, what is it, slippery slope. We're being encouraged that if we have any loans in our pipeline as of today that are going to be closing in the next 30 days, the alert is to lock.
Lock,
Go ahead and lock the rate.
lock and
So
load.
lock it. Lock the rate for sure. So we this is a time where, yes, certainly, we're all just sort of sitting on the edge, and we're keeping an eye on the market and trying to make sure, figure out, is we're gonna continue to follow historical trends and things like that. So it's definitely a good time to stay close to us, your MC, or whoever you're working with, to determine as a consumer what might be the best time to lock.
Right. And just as a base, what are they, like a 30-year fixed right now, basically, before you buy down the rate? Because we'll talk about that in a second too. What is it right now about?
Yeah, probably about six and a half, 6 and 7/8.
Okay.
Buy down 30-year, you can go, pay about 7/8 and buy it down to about six. On a 15-year, 5.5%, with a buy down of 7/8, which is 0.875. VA, we tend to price VA pretty aggressively, meaning low. So VA spending less money, 3/4 of a point, you can buy that down to about 5.625.
Right. So they're still in the realm of reality. They're still good. I mean, we were all in fantasy land for about a year with the rates, maybe even a little bit longer, and we started the year that way. But then the Fed had to get on the horse and go crazy because they're a little behind the inflation curve, right? So that's what they look at, because that's what we did in the '70s.
Yeah,
We started raising the rate crazily, and then it lowered inflation by slowing everything down. It's kind of crazy if you think about the way they want to do it, but that's what they do, right?
exactly.
So
Exactly.
cool. So all right, so tell us a little about. Okay, give us some. I know you guys have like your rate locks. You guys lock for a long time. You have all kinds of awesome programs. Give us a couple, please.
Absolutely. So I'm glad you asked. Thank you for that. So
Mhm.
honestly, I speak to a lot of agents, and oh my gosh, so many agents are bombarded by so many loan officers, right? And so I really do try to think about what are our ancillary products, or our product niche. Where are we in prosperity, and where we believe where we can offer more than our competitor. And so, given the current interest rate environment right now, one of the biggest that we have, or several, but let's talk about being able to lock an interest rate on a loan file where the borrower, where your client has not located a property yet. That's
Mhm.
huge.
Right.
So a free lock rate, interest 90-day, so sorry, we'll provide a free lock rate for up to 90 days, right? Now,
Mhm.
when we say free, that means we're not going to require a deposit, but there will be a different discount point or charge for 30-day, 60-day, and 90-day. But
Right.
for the consumer, there's no commitment up front. We'll go ahead and grab that and lock it. So when we lock it, we're locking at the current day's rate sheet. So that's huge. Most lenders cannot do that. We also offer the ability to rapidly get an underwritten approval within 24 hours if we're able to digitally verify assets and income. And we also are offering, I mean, there's other lenders that are doing this, but once we have a file that's we call buyer advantage approved, that's underwritten approved with a mortgage commitment letter, we'll
Mhm.
go ahead and guarantee that close. That will close on time. Now we have flyers for all of these options, and so there are some exclusions, of course,
Mhm.
but just ask either one of us for an actual flyer for more information about these.
Cool. Cool. Now that's that's awesome because 90-day rate lock is great, and I know even for some new construction, you guys will even push it out longer if somebody's waiting to close, right?
Absolutely. We'll go for new construction. We have a 1 year, 365 rate lock option.
Which is
So
incredible.
that works a little different, but it's amazing. And that's for new construction. Absolutely.
New construction, great, awesome. I love it. Okay, so tell us a little bit. Okay, so I'm somebody, and let's just use 6.5. The rate is 6.5 right now. All right.
Okay.
And I want to buy my rate down to 5.5. And I could make an offer with seller contributing up to X, right? Isn't it up to 3% if it's 5% and so forth?
Yeah.
Tell us a little about that process.
Okay, so it's going to depend upon the loan product, what the max seller concession is. And honestly, it's also going to depend upon how much the consumer is putting down.
Right.
Sometimes a concession can be up to 6% if they put more down. VA's for, conventional 3 at 5% down. So let's just use 3% seller concessions, right? So that can be definitely very beneficial for the consumer. So that's a trick question, Rick, but I'm just going to give you an example because you want to know about how much. It honestly changes every day, but to go from 6.5 to 5.5 in today's pricing is probably going to take 2 points, realistically.
That's what I figured.
There you go. So that 6.5 to 5.5 is 1 point, but it's going to cost a lot more to get to that because of the pricing structure. And
Right.
So that changes every day depending upon every lender's pricing structure.
Right.
So, but the moral of the story is it is very beneficial if sellers are willing to contribute to a buyer's point buy down, because we're finding that depending upon the price point, right, that could be a payment difference of anywhere from $150 a month to $400 to $500 a month. We've been doing some training, and I've got some flyers and things like that. Ask any one of us if you all are interested. If you have a listing and you'd like us to prepare a rate buy down comparison, we'll absolutely do that for you because it's mind-boggling. So on a $900,000 sales price, there was a spread between the spread was about $400 from the borrower not paying any points to paying 2 points on the buy down. $400 is a lot of money.
It's a lot of money over 30 years too. I mean, think about
30
that.
years, exactly. And even if you take the average time that someone stays in a home, over the first 5 years, 7 years, 3 to 5, it depends on who you're asking, but whatever, it's a lot of money. It's definitely a lot of money.
Yes, and I heard the new prosperity saying is marry the home, date the rate. Is that accurate?
Yes, that is accurate.
I love that
I
one.
guess. I don't know about that. I don't know if that's our official slogan, but I am hearing that
That's a good one.
buzzword.
No, meaning that you could buy. I mean, let's face it. I mean, you've been doing this for about 20 years too. I've been doing it for 37. I mean, my first home I bought, kept the rate for 3 years, and then refinanced it because the rates come down. It's not
Right.
uncommon. Okay, we've just been spoiled. We have to get out of our mindset that if you go back 4 months, right? But just call it 2 years, with the exception of the last 4 months. The market was not reality; it was fantasy.
No. Yeah,
Right.
fantasy land.
From an appreciation standpoint, from an interest rate standpoint. So now it'll take a little while for these buyers to to come down to reality. But here's the thing: it doesn't matter. We have an inventory situation regardless.
Exactly. And there's always a time to buy or sell. There's always time to buy or sell, and you can control your interest rate. So you and I understand that you control how much interest you pay over time. So you leverage that, as a buyer. So a lot of the more, I don't want to say sophisticated, but some people kind of understand the numbers, and if they know that they can get a home at a little bit lower than what it was last year. So what the rate is X, Y, and Z, they're able to get into the home now. I mean, there are a lot of people out there. So here's the benefit, honestly, agents. I'm excited to be here because there's a lot of movement within our company. People are still buying and selling. I promise you. We have many, all of us have many buyer contracts going on. My emails are going off. I should have.
You got a lot of tabs open.
I got a lot of tabs open. Like you have that cell phone and you got to close out the. Right now I have a lot of tabs open. I'm like, no, all good.
Yeah. That's great. No, you got to have a lot of tabs open because, I mean, it's like any other business. You get 10 people do the application, 7 of them end up, using you, 5 of them end up, you have to have all the plates spinning. Otherwise, you're not going to close the deals.
That's right. It's a numbers game, just like on the real estate side. When I have goals in my head, and the number of people I talk to per day does not equal the number of people who actually complete a loan application on my website or mobile app or talk to me. And then from those people who complete the loan application, everyone may not be pre-approved, and then from those pre-approvals, everyone may not close. So it really
Right.
is. It's numbers.
It's a totals numbers game, just like the real estate business, except a little different. You're doing the mortgages, we're selling the homes. But, that's why I'm so glad that we have this wonderful relationship with Prosperity, because I know as an agent, if I sit down with you and I give you this buyer and we work together, now we're going to close them together. It's going to go on to equity. It's going to close nicely.
Exactly.
It's a great system for super efficiency, customer service,
Absolutely.
and you guys,
Absolutely.
your rates are it's impossible. I mean, really, it's tough to beat your rates. Your rates are great.
And speaking of rates, I'm glad you mentioned that. We actually do have a rate meet or beat guarantee, right?
Right.
So on our conventional product, doesn't include new construction, but we definitely always look to beat new construction offers. But basically, that buyer just has to show me an actual loan estimate or a closing cost worksheet, something so we can see where all the numbers lay, if you will, lie or compared to each other. But yeah, just send that over to us. And if we can't beat that, we'll go ahead and pay your client $2,000. Now the flyers and the branches say 1,000, but it's actually $2,000. So that's
Wow.
huge. Of course, our
That is-
goal is not to pay it. So we're gonna so we price very low. We're not looking at it to take people to the bank at this point because because
right.
we want.
You're confident that you're going to do that, so that's why you offer the guarantee, just like the seller guarantee too. Tell them a little about that one. Like if you don't close on time,
Oh,
that's
yeah, sure. $10,000 seller guarantee, we'll pay them. So we don't intend on paying that out either. We offer that on our buyer advantage, which are already mortgage conditionally approved files before the contract is written. So it has to be conditionally approved before going to contract. But yeah, we'll go ahead and pay that out if we don't close on time.
which is a great guarantee. And then as an agent, you call your if you're working with another company, and you can say, look, at this is the guarantee we have on their financing, which is really helps them look at your offer as well. So it gives you an advantage.
Exactly. The agents that I work with and those files that come out of processing like that, I will send them the mortgage commitment letter along with the purchase guarantee. And when they get ready to write an offer, I'll even customize it to that property address or actual seller's name. So we use those as tools, along with probably some reduction in contingency dates, depending upon the file and the loan product and things like that. So yeah, absolutely.
All right, cool. All right, awesome. All right, well, tell us now, Lester, anything else that did I forget to ask you, or anything else that you think they should know as realtors, consumers, whoever happens to be watching this right now, as far as the market, the rates, blending. Like I know today, if I was a buyer and I was working with a buyer, I would say, look, here's what we're going to do. If you're putting
Hmm.
5% down, if you're putting 5% down and you're going conventional, we know we can go up to 3%. I would say, let's use the majority of that to buy your rate down. If I was going
Yeah,
VA, the rate's already better. I can use 4%. I'd probably use 3% of that to buy the rate down as low as I possibly could. If I'm going
yeah,
conventional, putting 20% down, we could go up to
yeah,
6%. So I would be talking to my buyers and saying, let's use a majority, instead of asking them to lower the price, let's get that rate down. And if
yeah,
I'm that's with buyers, and if I'm working with sellers, I'm saying, hey, let's offer as part of our,
yes.
offer out to the public a rate down. You can get this home today, at blah 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 based on today's rates. That's what I would be doing with sellers and buyers. What do you think as far as that goes?
Absolutely. I think that is an amazing something to offer to both sides because it's going to be huge and more beneficial for a buyer to contribute towards to buy down the rate in the long run. The couple of other things I will add to that is
Sure.
this. There is a myth out there that if you are a first time home buyer, you have to go FHA.
Right.
Um, And so I want everyone to understand that just because you're a first time home buyer doesn't mean you have to use an FHA product. FHA at minimum requires is 3.5%. Both Freddie Mac and Fannie Mae offer first time home buyer programs with as little as 3% down, right?
Mm,
Three is less than 3.5, right?
right.
And
Yes. By a half a
with the
point. I know that answer. I didn't even
but
need my
listen,
calculator.
right. You could do that in your head.
I
Me
can.
too, right? No, so basically, so not only do you have that, but you also have upfront mortgage insurance on FHA loans. That's
Right.
1.75%. And then your FHA monthly premium is much more than the conventional products under the first time home buyer. The MI, the mortgage insurance, is discounted. There's no upfront more. So when you compare, if a buyer can qualify, which a convention with getting into that program, it actually most of the time may be more cost beneficial or financially beneficial to a buyer to use conventional 3% down. So I want to just kind of share that. FHA is not always mandatory for first time home buyers. It just so happens that the first time homebuyer programs are mostly FHA products. FHA is a little looser on DTI, debt to income, reserve, lower FICO scores, things like that. But we don't have to automatically put someone in that product. Number
Right.
two, great news. The latest is that we're excited. So the conforming loan rate has rolled out for 2023, and some lenders are able to go ahead and originate according to that. Some are not. We are a lender where we are. So that means that we are now originating loans, conforming limit loans up to $715,000. That means $715,000. That means someone can buy a home with 5% down, up to $715,000 home.
And in
715.
Vegas, that's really good.
I'm sorry, that's loan amount, and that gets a little. Let's just keep 715. Loan amount, sales price different, but for all intents and purposes, it's amazing. It's a great opportunity
Right.
for someone to leverage, right, other people's money, put less down. If the ratios qualify, bam, they're in.
Yeah.
So I
That's
wanted
great.
to. So yeah, those two, and then what's the other myth? So real quick. Here's a real quick, and I'll make it quick, I promise.
No
So
problem.
here's the simple equation. It's simple, but it's not simple. But
Right.
here's the simple equation to qualifying for a mortgage. There's three different categories. There's income, there's assets, and there's credit. And so I think of it as a dating relationship. And I have a video out there that I need to repost. It's been about a year since I posted it, but I talk about this, the characteristics of a loan, comparing it to a characteristic of a diamond. So I know, right?
I can see where this is going.
But
Let's hear
anyway,
it.
so listen, income. So we need to know the source of income, and we need to understand the consistency going 2 years back and 3 years forward. Okay, in general,
Right.
and so people always say, "What about the same line of work? What about if I change? What about what?" There are some always what ifs, but let's just talk about income. Income is actually probably the most important part of the equation because it tells us the ATR, the ability to repay the loan. As
Right.
lenders, we're not making loans to foreclose. So a lot of times it is very frustrating for people for the things that we ask to determine that factor, and really think of it as the consumer's protection, right? The
Mhm.
borrower's protection. So we have income, we have assets. Assets, for when you buy a home, we look at assets such as checking, savings, investment stocks, gift funds, and down payment assistance. So believe it or not, all the money can come from a gift source as long as the gift source is related on a general conforming loan. Jumbo and other, those are different, but general conforming. So assets. So when you make an application, you just have to tell me and show me where are the assets coming from, what type of income, pay stubs. I mean, how long have you been there? How much do you make? Things like that. And then the last is credit, right? So FICO score is going to is one of the driving forces of the decision engine that Fannie Mae and Freddie Mac looks
Right.
at. So
Yeah.
that's, in
And
all those, there's
those three things make the decision. They usually go by the three credit bureaus and do the average or the middle score, right?
yes, We have a merged. We look at one. We pull credit once, but our vendor merges all three scores so we can see everything from all three. And not every lender does that, but we do that at Prosperity. So I'm not hitting credit 3 times.
Right. That's awesome. All right, Leistra. Well, hey, I just want to say from all of us here, especially Paul is enthralled on the other side of the camera. I just want you to know that. All right. All right. So thank you very much for taking your time out today. You know, Paul.
I do. I love Paul. Paul, he's
the secret weapon. Did you know that?
He's just steady Freddy.
That's right. That's what he is. Steady Freddy.
He walks around with a smile.
All right, Leistra. Thank you very much for taking your time out today. You rock. All right. We love it. And we'll talk to you soon. Thank you. Bye.
Bye.